Today in Financial Accounting Chapter 1, we will be looking at Objective 6. In Objective 6, we will identify the 4 different types of financial statements that corporations utilize. So what are financial statements? Financial statements are the primary means of communicating important information to the end users about a business. They represent basically a model of the business enterprise in financial terms. One thing to keep in mind, though, is financial statements are not the perfect picture of the business enterprise. There's more to a business than just can be seen in the actual financial statements. During this discussion, we will focus on the 4 primary types of financial statements issued by corporations: the income statement, the balance sheet, the statement of retained earnings, and the cash flow statement. So, first, let's look at the income statement. Our income statement, as we learned in the beginning of the year, summarizes our revenues and our expenses. It summarizes them for a period of time. It shows also either the profits or the losses for that business during that period of time, whether that period is a month, a year, a half year, a quarter, whatever the period might be. It is considered by some to be the most important report because it shows whether that business is achieving one of its goals during that period, whether it's achieving the goal of profitability during that particular fiscal period. As we proceed through and look at the corresponding reports for each of these types of financial statements, pay attention to the flow of the arrows. And when we look at the reports, I will also give you tips on how or when that particular report is prepared. With regard to the income statement is typically prepared first because it shows the net profit or loss for a particular period and is needed, that information is needed to complete the other financial reports, including the statement of retained earnings and the balance sheet. So in the flow of the process, we generally complete the income statement first, then complete the statement of retained earnings because the retained earnings is needed to be incorporated into the balance sheet. So it goes income statement, statement of retained earnings, and then balance sheet. So let's look at an example of our income statement. As we can see here, just like in the first semester of the year when we looked at income statements, our income statement starts out with a heading. We see the name of the business entity, the title of this report, and then we see what period that report is for. In this case, we have an income statement and it's for the period ended December 31st. Then we see our categories of revenues and expenses and our net income or loss. In this case, there's a net income or net profit. We see our revenues in the form of commissions earned, and then we see our expenses in the form of equipment, rentals, wages, and utilities. And we see a total, and then we see the total for our net income, which is the total of our revenues minus our expenses. We then take that amount, that net income amount, and that item is going to trace through or follow through into the statement of retained earnings. If you recall, back in objective number 5, I had explained to you that our stockholders' equity is consisting of contributed capital plus retained earnings. So we have to get the information for the retained earnings by accumulating that earnings or losses, whatever the case may be, and adding or subtracting that into the accounting equation. So let's look at the next step here. The statement of retained earnings, which is a component of the stockholders' equity section of the balance sheet, the statement of retained earnings shows the changes in retained earnings over a period of time. It shows all the factors that impact the retained earnings of an organization, such as profits and losses and dividends. This can also be called the capital statement. Here's an example of a statement of retained earnings. Again, we can see that we have a heading here. name of the company, the actual financial report that it is, and the period of time. In this case, we can see that we have the beginning retained earnings, the earnings that we had at the beginning of the period. Then we add to it any net profit for the period, or if we had a loss, we would subtract it. We can get a subtotal, and then we would subtract our dividends from that to get our ending retained earnings. This would look very similar, if you remember, to the equation that we had during the first half of the year, where we had the beginning owner's equity, and we would add to it any net profit or loss, and we would subtract from it any withdrawals during the period. This is very similar to that, okay? And then we can trace this ending retained earnings balance to the owner's equity section of our balance sheet, just like we did in the first half of the year with our owner's capital section. If we look at this formula from an algebraic standpoint, it's going to look like this. Beginning retained earnings, BRE, plus or minus net profit or net loss, and minus dividends is going to give us ending retained earnings, ERE. These are the abbreviations I will use throughout the semester as it relates to this particular equation. Next, let's look at the balance sheet. The balance sheet shows the financial position of a company or a corporation at any point in time. It's as of a date in time. It is often called the statement of financial position. It presents the business as a holder of resources or assets that are equal to the claims against those assets by its creditors or its stockholders. Here's an example of a balance sheet. It looks slightly different than the balance sheets we've looked at during the first half of the year, in that instead of our assets being shown on the left side and our liabilities and stockholders' equity being shown on the right side, we now lay them out vertically, with our assets being at the top of the page and our liabilities and stockholders' equity being below that. We still do have our heading, the name of the company, the name of the financial report, and as you can see here, we see it as of a date in time, December 31st. We can see here that our liabilities and stockholders' equity sections are broken out in more detail. We can see that our stockholders' equity is broken down into common stock, which is also known as contributed capital, and we can see the retained earnings. The two combine to give us our total stockholders' equity. So our common stock plus our retained earnings give us our total stockholders' equity. And then our total liabilities plus stockholders' equity are essentially the right side of our accounting equation. The last financial report is called the Statement of Cash Flows. The Statement of Cash Flows explains the reasons cash changed during the fiscal period. It is based on three primary areas: operating, financing, and investing activities. The cash flow focuses on, in this case, the business's liquidity goal. Just like the income statement focused on the profitability goal of a business, the cash flow report helps us to show how the cash in a business flowed or moved during a period. It helps us to see our liquidity goal, which directly is our cash flow. It shows how cash was either produced by the operating, financing, and investing activities of that business during that accounting period. It is derived from a combination of the income statement and the balance sheet. So both of those items have to be prepared first before the cash flow statement can be prepared. It is essentially directly related to the other three financial reports. Here you can see an example of a statement of cash flows. Again, we have our heading at the top of this report. We see the name of the company, the name of the report, and what period that report is for. Next, I want to break it down for you and show you the three different sections. we see that the report is broken down into our operating activities, our investing activities, and our financing activities. Within each of those different categories, we see the different types of accounts that are reported for those categories. So within the operating activities, we see that our net income is reported here. That net income will flow back to our statement, our income statement that we already reviewed. We can then also look at the operating activities in terms of our balance sheet and the increases in our assets and or liabilities as it relates to those that are generated from the operations of the business. So our accounts receivable, our inventory, our accounts payable, those all have to do with the buying and the selling of the operations, those things that affect the operations of the business. Then we see our investing activities. So those things that the business invests in during the period, land, building, and then we see financing activities, whatever the activities are that help to finance that business during the period, whether it's additional investments by stockholders or the distributions of dividends. At the end, we can see how is the bottom line of the cash affected for this business during this fiscal period. In this case, it's a month. And we can trace that end cash to our balance sheet. So our focus question for the end of this section is, why is the balance sheet sometimes called the statement of financial position? Please write your answer on the corresponding space in your notes. Please answer the following questions regarding financial statements and click the Submit button when done to submit your responses. Thank you.